73% of executives cannot accurately define their company's free cash flow in under 60 seconds. According to a 2026 McKinsey survey of C-suite leaders across Asia Pacific, that same gap exists in how they manage their personal wealth. Free cash flow isn't an accounting metric you delegate. It's the oxygen in your financial system. And most leaders are suffocating without knowing it. Here's what keeps executives awake at night, whether they admit it or not. You've built a six-figure income. Your title commands respect. Your investment portfolio looks impressive on paper. But when you actually look at your bank account at the end of each month, the cash isn't there the way it should be. You're making more money than ever before, yet you feel no wealthier. This isn't a spending problem. This is a cash flow architecture problem. Most high-income earners operate on the cash flow principle of their mid-career selves. You've scaled your income. You haven't scaled your visibility into where that income actually goes. The gap between what you earn and what you retain grows wider every year. And the financial system is perfectly designed to make you ignore it. In Singapore and across Southeast Asia, executives face a particular trap. Tax structures are optimized for regular income, not cash flow. Lifestyle inflation happens faster when your peer group is making serious money. And financial advisors sell you products instead of frameworks. So you accumulate assets that look good in conversation, but generate no actual cash. This is what we're doing in the next 9 minutes. We're going to give you a framework that separates successful wealth builders from high earners who stay stuck. Free cash flow isn't about budgeting. It's not about cutting expenses. It's about visibility and prioritization at the level where real money decisions get made. We'll show you how to calculate your true free cash flow number. We'll walk through 3 executives, each earning significant income, each with completely different cash flow realities. And you'll see exactly how to apply this framework to your own situation. Whether you're in Singapore, Mumbai, Sydney, or leading a regional team across multiple markets. This isn't theoretical. These are the metrics that institutional investors use to value companies. You're going to apply those same principles to value yourself. Point 1. Free cash flow is what remains after you fund your obligations and opportunities. Not what you earn. Not what you think you should have. What actually remains. Here's the foundation. Your annual income, minus your committed expenses, minus your required investments, equals your free cash flow. That's it. But the power is in how you define each component. Because most executives misclassify their expenses. According to Deloitte's 2026 Asia Pacific Wealth Management Report, executives across the region underestimate their annual committed expenses by an average of 31%. Committed means non-negotiable. Mortgage or rent, insurance, debt servicing, children's education. These aren't options. These are obligations your income is already promised to. Real example. Take Rajesh, an operations director in Bangalore earning 2.4 million rupees annually, roughly $28,800. His committed expenses are 14 million rupees. He thought he had plenty of free cash flow. When he actually mapped it, he discovered his committed obligations consumed 60% of his gross income. Not 50%. Not 40. 60. His free cash flow reality was 4.8 million rupees. Not the 12 million he assumed. That's a 150% gap. Application for you. Build a zero-based map of your committed expenses for the next 12 months. Not what you think you spend. What your actual bank statements show. Insurance premiums, childcare, mortgage, education fees, Care for aging parents. This is the number that doesn't move. Everything else is optionality. Once you know your committed baseline, everything changes. Point 2. Required investments in yourself are not expenses. They're obligations to your future earning power. This is where most executives derail their free cash flow. You've built influence and capability. That capability requires maintenance. Professional development. Healthcare beyond the baseline. Your network. Your credentials. These aren't luxuries. They're the infrastructure that protects your income stream. A 2026 World Economic Forum report on leadership continuity found that executives who invested 3 to 5% of their annual income in continuous learning and skill development maintained earning trajectory through economic shifts. Those who dropped below 2% saw their earning power erode within 4 to 6 years, regardless of seniority. Consider Mei Lin, a regional finance director in Singapore earning 220,000 Singapore dollars annually. Her base committed expenses were 80,000. She thought her free cash flow was 140,000. But she wasn't accounting for professional development, health optimization, and strategic certifications. When she mapped her required investments in maintaining her competitive position, that number was 12,000 per year. Real free cash flow was 128,000. Not 140. It doesn't sound dramatic until you realize it over a decade. The insight is this: required investments extend your financial runway. They are not discretionary. They are defenses against obsolescence. The executives building wealth aren't the ones who cut professional development. They're the ones who optimize it. They're ruthless about what they invest in. But they invest application for you. Map your required investments in the next 12 months. Not what you want to do. What you must do to protect your earning power. Leadership coaching. Certifications relevant to your industry. Healthcare investments that prevent health crises. Insurance that protects your income. These are priority 1 after committed expenses. What remains is actually available for wealth building. Point 3. Your free cash flow margin is where real wealth happens. This is the difference between successful executives and those who stay on the treadmill. Most executives see this gap and immediately think, I should save more. I should invest more. That's not the insight. The insight is that you have a measurable asset. Available cash flow. How you deploy that asset determines your financial trajectory. According to a 2026 IDC report on executive wealth building patterns across Asia Pacific, executives with visible free cash flow frameworks saved 37% more annually than those without, not because they earned more, but because they made deliberate allocation decisions instead of default ones. Real example. Take David, our operations VP in Sydney, earning 380,000 Australian dollars after committed expenses and required investments. His free cash flow was 148,000. Most years, that cash disappeared. Credit card statements showed dining, travel upgrades, technology purchases, lifestyle inflation. No intentional allocation. David implemented a simple framework. 50% to wealth building vehicles, 30% to optionality and experiences, 20% to reserve. That allocation meant 74,000 per year into investments. Over 10 years, compounding at a conservative 7% return. That becomes 1.2 million Australian dollars beyond his base retirement contributions. That's the difference between a comfortable retirement and a wealthy one. Same income, completely different outcome. The framework is not complicated. After you know your committed expenses and required investments, what remains is your free cash flow. That number, deployed intentionally, becomes your wealth-building engine. Application for you. Calculate your monthly free cash flow number using actual bank statements from the last 3 months. Subtract committed obligations. Subtract required investments. What's left is your actual available cash flow. That number doesn't lie. Now make an intentional decision about how to deploy it. Don't leave it to default spending patterns. Conscious allocation is where wealth separates from income. 6 months from now, you know your exact free cash flow number. You're not guessing. You're not hoping. You're operating with the same visibility that institutional investors bring to asset allocation. Your committed expenses are rationalized. You've challenged every obligation. You've eliminated the ones that don't serve you. You've negotiated the ones that remain. That number is no longer a mystery. Your required investments are strategic. You're not spending on development randomly. You're investing in capabilities that directly protect or extend your earning power. You're no longer bleeding money into generic professional development. You're surgical about it. And your free cash flow is deployed with intention. You're not leaving it to the spending decisions of your tired brain at the end of the day. You've created a framework. A portion goes to wealth-building vehicles. A portion goes to experiences and optionality. A portion stays in reserve. You're building wealth deliberately, not accidentally. And here's what actually shifts. The constant low-level anxiety about money disappears. Not because you earn more, because you understand where every dollar goes. You make deliberate decisions about your financial future instead of hoping it works out. You're no longer hoping. You're building. That's the actual transformation. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.